We want to welcome you to our Renovation Lending Made Simple webinar. I'm going to introduce myself, Ginger Bell. As I said, I'm an education specialist with Go-To Training. I work with Finance of America to help them to bring education to our originator and realtor community. And with me today, I have William Brown. William is the National Renovation and Sales Manager for Finance of America, and absolutely amazing person and has so much experience with renovation loans. And William, I learn something new every time that I get on the call with you. So I want to thank you for your expertise and your commitment to our industry. But let's talk about renovation lending, and let's start with, why do you feel that this is a completely underutilized solution?
So I look at 300 billion in renovation financing. I think that's the number that Harvard is expecting to have happen for the next, annual for the next several years. So, and I look at the first mortgages that people do, which a lot of them come through realtors, like their purchases, and there aren't very many renovation loans. So I'm expecting that the realtors aren't aware or willing to discuss the product with the borrower who comes to them first, or they're unaware that it is available, right? So my questions for the realtors are like, what do you do when you have a borrower who dislikes every house you show them and they take it apart, and you've already done your homework? You know, you've interviewed them, they fill out your form, they told you what they're looking for, style, age, floor plan, number of rooms, bedrooms, orientation sometime, where on the street, big trees, little trees, all that stuff. But then they don't like any of the houses that you show them, right? So that's a problem that happens in a lot of markets. So that's one. The other is, how many houses do you show people before they write their offer? And I kind of liken it to buying a car. When I buy a car, I shop online like everybody does. People shop for houses online. Then I find the car I want. I haven't got there yet, but the next car I buy, I'm just going to order it online and let them deliver it to me. I haven't got there yet, but I know somebody.
Right. That exists. You can do that.
It is a thing, right? And so, why do you have to show me 5 or 6 or 7 or 8 or 9, 10 houses before I buy a house? I'm going to live in it 5, 7, 10 years, maybe for the average. Probably keep my car 2 to 5 years. It's about the same, right? The house is way more expensive than most cars, but still, why do you show them so many houses? And so then the question for both these questions would be, would it be beneficial to you as a realtor to show the buyer fewer houses to get them to write an offer, so we can compress the sales cycle a little bit?
Right. And that's really something I think homeowners are definitely doing a lot more shopping online. So we're seeing that change as far as how many houses. But the problem is there's not a lot of houses out there. And so oftentimes there's a house that they may not find appropriate. And so that's why we've created the agenda to what we're covering today. And these are the things that William's going to answer for you. First of all, what is a renovation loan? And we're not talking about the ins and the outs and the ups and the downs and all the guidelines of a renovation loans, but the very high level, 30,000 foot level, what's a renovation loan? What are the details? What are the allowed repairs by the particular loan type, which is important to know when you're going out and showing houses, or if you have a listing, just to know, hey, this would be a great home for a 203K. Do you know about it? What happens after closing? Because that's always important to know. And then what are the benefits to the consumer, and what are the benefits to you, the realtor? And why use Finance of America for your renovation loan? So let's begin by starting with, what is a renovation loan? And William, you do a great job of defining what it is.
So this is a fully amortized single close transaction. It's not a construction loan. There's no interest only period. It is either a conventional or a government FHA loan that acts like a regular conventional conforming loan, high balance, or FHA county limit or high balance. One closing, the cost of the repairs are in the money. Okay, so it lets home buyers transform the home they purchase into the home they want. There's a lot of leeway, there's a lot of stuff they can do. It's based on the as completed value appraisal, so most of them work. I've seen thousands of them go through. It's a single digit percentage of appraisal issues that I've seen over 10 years. There's not a whole lot. It finances the purchase or the payoff if it's a refi, plus all the costs of the renovation. So that's going to be your building costs, material and labor. It's going to be costs for inspections. It's going to be costs for permits. If they had an architect, we can finance the architect drawings and renderings. All that stuff is rolled into their mortgage payment, right? And because it uses the after improved value, like I said, it's been single digits, over several thousand renovation loans of all types that we've seen through our op center that have appraisal issues. So it's not, I don't know why, they just, most of the time they work. Almost all the time they work.
Let's talk about
So,
how the loan works then as far as the process.
right. So when you are talking to your buyer and you're writing the purchase contract, you're going to write it for the sales price. So essentially the borrower has two transactions happening here that come together as one at the closing. He's counting on you to negotiate the best you can for the best sales price. Then he's also working with his loan advisor, his mortgage advisor, to structure the loan with a renovation budget into his loan. Okay, so that's really how it works. There's two things happening at the same time. The seller concessions, they're based on the purchase price, but his down payment is based on the total cost of acquisition. So all the money he borrows is what the 3.5 or 3 or 5% is based on.
Sure.
We hold the funds. The lender holds the funds.
Information can I?
And on a
Hold on, I lost William here. Just a second here. William, are you still on?
540, you said?
Okay, so while we're figuring out where William went, I'm going to go ahead and finish going through this for you. And William, if you, oops, let me see if I can unmute him. There you are. Is that you, William?
Yep, that's my hand. I raised my hand.
Thank
Okay.
you.
Well, the real William Brown, please stand up.
I know, right?
Weird. Okay, and so we've got like three kind of renovation loans. The most common, probably half of them, are limited 203K. They're for cosmetic stuff. They're about $30,000 worth of repairs all in, right? And the contractors get half of their money up front. On a standard 203K, the builder can get special order items. And on Fannie Mae HomeStyle, we can give up to 50% of the material cost shortly after funding. They're designed to help the builder to facilitate them getting the work done.
So let's talk about the basics.
Okay. Single close, fully amortized transaction, right? So there's no interest only period. Their mortgage payment is due the first day of the month following the month they close in, like a regular mortgage. It's based on the after improved value, which makes it work, and which sets it apart from like a home equity line or other ways borrowers finance their homes. The work is all completed after closing. The buyer picks the contractor. The seller makes no repairs. So, if you have a house that needs work, fails a conventional appraisal, or the seller just isn't going to put any money in it, but it needs stuff to be done to it, then that's the buyer's deal. It's actually better for the buyer. Most buyers appreciate being able to go in and change the home and make it the way they want it to be. The contractor is always paid by a two-party check after the draw inspection and title update are received. So that takes about 5 to 7 days. It's not a long time. We work really hard to make sure we pay the guys on time in a timely manner. So that's like the basic part, right? So fully closed, based on after improved value. Buyers got to get their own contractor. Seller makes no repairs. You get paid at the table like a regular transaction. Seller gets their money, and then the borrower manages the repairs.
I think the important thing is everything kind of goes along as planned as far as the transaction, all the way up to them moving in and the realtor getting paid, and the note getting paid off from who they're buying the home from, and then after that, that's when the construction begins.
Correct.
So we're getting one comment: most agents don't want to wait any additional time to close. So you're not waiting any additional time to close. It really isn't the problem with the loan, because they're just saying that's the problem with the loan from the point. But as far as additional time to close, there's probably an additional 15 days that's going to be needed because of the appraisal, because of the process, and because you have to go out and get the contracts and things like that. So is there added time in there? Absolutely. But when you look at some of the homes that are out there in the market that need some repairs that maybe you're not going to be able to close because of that, then it can open a market for some homes for you that you're not having that ability right now. So an extra 15 days is not a long period of time if you can look at adding a couple more homes that you're selling per year. So think about it from that time frame. You're not going to do it on every transaction. It is going to slow things down a little bit, but it's also going to help you be able to sell some homes that you may not be able to sell right now. So let's look at some before and after pictures, because this is really where it comes in, where you can really see the results. And these are the kind of things too. Think about, put your marketing hat on right now and think of if you had a home that was like this and you were able to work with a client who did a 2 or 3K or a home renovation. There's other products that are available William's going to talk about. But they took that home and they were able to turn that home into something that looked like this. Now, if you would take that and you would create a video out of that, kind of your own kind of a love it or list it kind of a show, you could use this as marketing for you and your expertise in what you do. Now, are you going to get a ton of 2 or 3K loans because you do that? Maybe, maybe not. But are you going to be able to position yourself and grow your business? Yes, you are. And that's what you need to think about when you're looking at these particular loan products. That's the thing, to be able to position yourself as an expert. So that's kind of the hat that I want you to put on when you're looking at these. And to realize that the opportunity does exist there. So let's talk about some of the details and the features about the purchase contract, William.
Okay, so I want to know how to get this done. If you're doing a 203K, which is an FHA loan, either a limited or a standard, you have to have these 3 lines, 3 and a third lines. You got to get those in your purchase contract. That's required language by HUD. It's not specific to Finance of America Mortgage. It is actually, if the contract doesn't have this language in it, HUD considers the loan file to have a material defect in it, and they withdraw their insurance. Okay, I'm 110% certain of that. So if other lenders that you're dealing with are not requiring that, I can't speak to that, but I have spoken to HUD, and I've been in several conversations with them about files that we've had where this language was not in the contract, and the hoops we had to go through, getting affidavits signed, making sure the borrower knew, all this stuff, and then having HUD accept that is the only thing that kept them from being indemnified, which means that HUD withdraws their insurance, which means we have a loan that really is not performing. Okay, so, and if it's a HUD REO, make sure the first box on line 4, check the block on line 4 from their contract, and there's another box on there that says 203K. Those have to be checked for HUD to recognize that the loan was marketed or the purchase agreement was accepted as a 203K mortgage. Ginger already mentioned the time frame. So we're going to need 45 to 60 days to close. And the reason is it's more complicated. We have to get bids. We may have to get a HUD consultant. There's other parts that come into play. There's a lot more people involved. So we just need the time to get it done. If you get a 60-day contract, that's usually the best, because we're not going to hold it. Our goal is to close it as soon as possible. And if you get a 60-day contract and you want to close on day 60, and that's possible, that's when we'll close. But if we can close earlier, and that's okay with everybody, if everything's done, we would close earlier. So really, when you're writing your contract, it's really just a matter of setting the expectations of the seller and the other agent and the buyer so that we have time to get the work. And those of you that have been in the business, put yourself in the shoes of someone who's a first-time home buyer. They're buying a house, and they're doing a renovation loan. It's like mental overload for people to figure out what's going to be done, who's going to do it, how long does it take him to do it, what do the bids look like, are the bids right? The constant play of data that just keeps changing, that's why we need more time. It's more complicated. Here's a short sample. So this is actually limited and HomeStyle. Okay, so this is just a short sample. Shows if it was a limited 203K, and to your right of your screen, these are if I put in a conventional option, which is a Fannie Mae HomeStyle, so you can see the differences in payment and work. But it's a $200,000 purchase. We've got $30,000 in repairs and all the fees, which are title updates and inspections, etc. Total acquisitions $230. So there's your down payment difference. $805, which is 3.5% for FHA, $8,050, and 6,900, which is the 3% down payment for Fannie Mae's HomeStyle. Your base loan amount, you see there's a little difference there. Then you have your monthly payments, a little difference with taxes and insurance, and so that's where it is. The monthly payment difference, it's like $100 different, 120 maybe different. And really we're looking at is the MI factor, which is variable. I just made these up, and depending on their FICO, the location, the total loan amount, the MI would probably change. So we just wanted it to be, that's an estimate. So you can see it's not really out of the ballpark, but the borrower who could afford this now has a new kitchen or flooring, HVAC, and a roof or whatever, and it's in their mortgage payment, so they don't have to go assume more debt to fix the things that the house needs to be done.
Which is really important, especially when you're looking at your first-time home buyers. So let's talk about appraisals, and then we'll quickly move on to property types.
Okay, so appraisals we're talking about, we're going to get one, for purchase, we get one after improved appraisal. And this appraisal, we assume that the purchase price is the as-is value, and the after improved appraisal is the appraisal that's ordered after we have the bids and the documentation that show what work is going to be done, so the comps are based on the improvements that are being made. All right, so that's the house the way it's going to be. Single family, condos are allowed, and they have to be FHA approved or Fannie Mae warrantable, and it's going to be walls in or per the association agreement. Usually that's just the walls, and this agreement gets the doors and windows, but I have seen some where the homeowner is responsible for doors and windows. We can do townhouses. We can do 2 to 4 units as long as they're owner occupied. Fannie Mae allows for second homes. They also allow for single family resident investment properties. And these are great for foreclosures. And I say short sales, and it makes me nervous. We do them. Everybody's always in a panic because you can't go until the seller says go, and then they want to close in a hurry. But they work for short sales. As long as the seller knows you're doing a renovation loan, we can usually get them done without a whole lot.
And it's well executed for that, but still a possibility. So if those are out there, it's good. So a couple more before and after pictures. So this, I'm assuming, is a typical basement, right?
Yep.
So, and if you're in homes, I know I grew up in Colorado, so lots of homes with basements there. Illinois, there's a lot of areas that have basements that are older. So if you could take a home and sell it and let them have the money to go and fix it up into something as beautiful as this, just think of the possibilities that you could have.
Yep. So, the only thing on basements is, remember, it's below grade, so they're going to get some value, but not as much as if they blow out the attic and build this lovely thing upstairs. But it does add value, and it makes a better living space. It increases the livability of the property. Right,
and that's the thing to look at. Okay, so let's talk about the different programs.
Okay.
3 different types, under 203K, but under 203K too. There's the limited and the standard, right?
Right, and the limited is really cosmetic. So when you're thinking about limited, that applies for most first-time homebuyer homes use the limited 203K. We used to have a slogan that says every B should be a K. And that might be stretching a little bit, but what we know is that people buy their houses and spend $10,000 to $20,000 fixing them up in the first couple of years they're living in them, and they did that with their credit cards or their cash or their savings or whatever. So every B could be a K. It's $35,000 all in, but the bids is really $30,000, and that leaves a cushion for a contingency reserve, the finance inspections, and title updates that have to be, and permit costs. This allows no structural repairs, so if it's part of the structure of the house, they can't do it on a limited. This one also allows each contractor to be paid twice. They can only get 2 payments. They get the initial payment about 5 to 7 days after settlement, and then when they finish their work, we inspect and pay them. And we don't make the 3 contractors, they can have up to 3. We don't make them wait until everybody's done to get paid, because that just drives them crazy. So if the HVAC guy's done, we send the appraiser out, he inspects, he says, yeah, it's in, it's on, it's working. We cut him a check for the balance of his money. He's not waiting 3 weeks for the cabinets to come in. Here's some common repairs that happen. And you can see you got different tradespeople in there, different time frames. That's why if we have 3 guys, we're not making anybody wait on somebody who doesn't work for them to get finished.
Right. Now, the biggest difference between the standard and the limited. So the limited up to $35,000. The standard has a minimum of $5,000.
Yep.
The limited, no structural repairs, but the standard lets you do basically everything that you want up as long as the foundation's still intact, right?
Yeah, that's the thing. So people ask, what can I do? And I can actually quite frankly tell you if it's a 203K standard, you can tear it down to the foundation and rebuild it. It's not new construction as long as we use 100% of the foundation. It's a renovation. That's HUD's definition.
Right. And some of the additional things you can do, like a detached garage, a new deck, a patio, new landscaping, the typicals as far as their interior and exterior painting and siding, which is part of the limited, but complete room additions. You can add a bedroom, you can add a new family room. Like William talked about, being able to bust up and build up rather than, finishing a basement. Those are the things you can do on a standard. And so, again, you look at those before and after pictures, and this is one ugly kitchen. How many of you ever had a house where you had something like this? It's like, oh my gosh, what am I going to do with this? Well, years ago when I started working with realtors on doing the 203K is we would make up a sign and we would, put a sign in an ugly kitchen like this, get a bunch of books, samples from Home Depot, put it out there on the counter and said, don't like, you choose. And we'd put them into a 203K loan. And every single time we did that, William, in an open house, we got full offers right away, multiple offers. And so those are the kind of things that are great to be able to do that, especially as our market is shifting. Things are changing. The cash buyers aren't out there like they used to. So you can take a home like this and turn it into a home like this. So those are some of the things that are available for you. So let's talk about another great program that I love, which is the Fannie Mae HomeStyle Renovation Loan Program. And this is one that's a little bit different than what you may be used to on the 203K. So let's talk about what those provide.
Okay, so this is Fannie Mae's solution to rehabilitate residential properties. Like the K, it finances purchase or refi, plus all the costs of repairs. This one expands the type of properties that are eligible with second homes and investment properties. Okay, so that's really huge. It has some other nice features about it, which sort of make it the creme de la creme of renovation loans. But this is how it works, okay? So uses a construction project manager, we source them. There's no minimum in repairs. And line 3, your repairs are capped at 75% of the as completed repair value. That covers probably 98% of the deals that you would ever see. And so you don't have to stress about that. It's not the purchase price. That's just how much you can spend on repairs. Okay, so it goes up to 75% of the as completed value. Could be on rehabbing the house. There is always an inspection prior to dispersing draws, and there's up to 5 draws. Like the standard 203K, they can finance up to 6 months of their full principal, interest, taxes, and insurance payment if they have nowhere else to live and they have 2 housing payments. Everything has to be attached to the property and supported by the appraisal. So there's no restriction on repairs. That's the restriction right there. Attached to the property, supported by the appraisal, period. Pool, jacuzzi, bowling alley, tennis court, basketball court.
And this can be used for investment properties and second homes too, guys. So outside of what you're used to with the 203K, this actually expands into a whole nother area as far as ownership of those properties. So think about that as well. And again, positioning yourself, being able to put yourself market. One of the great things is to, work with a Finance America loan originator who invited you on the call and do some marketing together on something like this and work with some, remodelers in your area to be able to tell them about, the programs that are out here. So it's an opportunity for you to really market and position yourself. Now, William, I don't want to go through all of these comparisons. We have created for you some pretty cool 203K between what the LTV requirements are, the types of repairs, the costs, credit scores, things like that. They are available in the guide, so we're not going to go through those line item by line item, but we did want you to have those available. And you're not going to really need to know about this because you're going to be working with an originator who knows about this. But, sometimes I always like to have that knowledge and have access to it. So it gives me an idea and it helps position me as an expert. So let's talk quickly about after closing, which for most real estate agents, once you get done with that transaction, you're ready to move on. But if you're building those long-term relationships, you want to stay in touch with them. So you want to let them know, first of all, what the process is. Second of all, you want to hear what's the house look like when you're done. Have a reveal party. Have a big reveal party. Take videos of it and promote it out. That's a great idea because it doesn't take long for everything to get done, right?
Right. Okay, so everything starts after closing. There's no repairs prior to closing. They have 30 days to start after the closing in case they have to order things. Like I said, the borrower starts making mortgage payments, normal schedule, unless they're financed into the loan, in which case we will make their mortgage payments out of their escrow account. That's a separate escrow account that has their payment in it. And we have 6 months, to finish that. And we can escrow up to 6 months of their payments if the house is unaffordable, is not habitable. So your draws are slightly different on the on the limited 203K. They're automatic. We will automatically send 50% of the contractor's payment shortly after the loan closes to each contractor, two-party check to the borrower. And then when they finish, they'll get paid. The standard, if they're not having a material draw up front, then they just go to work. And the contractor is big enough, we're assuming, to carry the deal for 30 days until he's completed enough work to get paid. So usually after the demo and cleanup, you may get paid unless we special order cabinets or flooring or trusses or something like that.
And again, another before picture of a lovely bathroom and how great that can look after that. So, we like to show some pictures to kind of get you in that mindset of these are the possibilities. These are actual renovations that have happened on renovation loans. And so let's talk about some of the benefits that you can talk to your homeowners about.
Okay, so for you guys, it's one application, it's one approval process, one closing, and their one payment. So they don't have extra debt. Their credit card balance hasn't ballooned or anything. It's all in their mortgage. The loan's based on the after improved value, which, as I said before, makes the loans work because they're comping it as it's going to be, not as it is. Repairs can include both required and optional repairs. 203K limits the optional repairs to luxury items, but that's a pretty narrow band of stuff. Really, it's like your indoor jacuzzi, your sauna, your bowling alley, your tennis court, stuff like outdoor kitchen. Okay, but it's not stainless steel appliances. It's not hardwood floors. It's not marble, granite, or marble countertops. With the cost of new construction higher than resale, a lot of people can create the home of their dreams and maintain the resale cost. So they're buying equity. Okay, they're buying the house.
I like that. Yep.
So for you guys, what that means as an agent is if you stay close to me and keep your face on my fridge, when I get ready to sell my house in 5 or 7 years, I'm in a better position than if I just closed, took on more debt, sort of got the house sort of done, kind of fixed up and not really, and now I got to sell it because I got a different job and I got to move. This one's done. We knew what the value was after they closed it. They closed with equity. They are able to get more money out of the house for a bigger down payment on their next house. Seller doesn't make any repairs. That's huge, right? All the repairs are made after closing. Ideally, you can show them fewer houses because you can ask them, would you be willing to write an offer on this house if you could finance whatever it is that they don't like about it? Okay, so you don't have to show them so many houses. If there's a low inventory solution, usually the homes that still need work are available. Might be a buyer's market, might be low inventory, but if you drive around, you'll find some houses that need work and there's not a bidding war on those houses. You can just show people homes that have good bones, but they need reconfiguring. Remember, we can expand the footprint of the house as long as we use the existing foundation. We can add a wing on that little, shotgun ranch or whatever. You can show older homes, and they can upgrade the HVAC, kitchen, appliances, windows, roof. Foreclosures, they're usually a great bargain, but they almost always have repairs. Something's missing, especially the longer they've been empty. You can target exhausted listings. If you're not a listing agent, find the listing agent in your office and find out what they're doing to sell their houses that have been on the market for 60, 90, 120 days. And the important thing is you get paid at settlement like a traditional real estate transaction. So we did all this work, you get paid, boom. And now the buyer is working on fixing up their house, and you can check back with them, see how it's going, see if they have anybody else that could use the loan.
And build a variety of portfolios like this where you can put together your own before and after pictures. When you take, my gosh, here's a kitchen that looks like this, very dated, and you can turn it into this beautiful new kitchen. So benefit for your borrowers, benefit for you. And if you play your cards right and do your marketing and build a portfolio of products like this, then you can actually use it for a great marketing campaign as well, which I think is important to do in this market today. So, William, why Finance of America?
30 years of experience. This is what we do, okay? So like a lot of lenders who maybe dabble in renovation loans, this is really what we do. It's what my job is. It's what my staff's job is. We have dedicated support staff. What's really important is we have a renovation project manager that every loan gets one, and this person works in our ops center, and they support their salespeople and you by managing the renovation part of the loan and working directly with the consumer, the borrower, to make sure that we get all the pieces of the renovation package together, that the bids work right up, whatever it takes, whatever the underwriter is called for to approve the loan relative to the renovation, we do that. And we've been doing it together, some of us for going on 9 years together. And I've been doing this renovation loans for a very long time. And I worked as a builder. I built houses. My Uncle Billy was a bricklayer. I spent summers laying brick.
I love
Yeah,
that.
we understand how the mortgage business works. It works really well. So we take this common sense approach to staffing to get the loans done in a timely manner. You will never be in the dark because you'll always know what should be happening, who's supposed to be doing it. The project manager keeps you in touch. We send a project calendar that shows who's supposed to do what by when. We're just trying to make this as seamless as possible, and we're staffed to do that. So that I think we do them right. I think we have probably one of the best ops in the country. We're totally committed to everybody having a good experience, and we're doing everything we can to make sure that happens, whether it's the borrower, the loan officer, you, the realtor, the builder, the HUD consultant, everybody. And the project manager, I think we're the only people that do that right now, that have a dedicated person with construction technology background, building experience to do that, right? So they work directly with the borrower and their regular credit processor, planning the project, make sure they understand it, what the requirements are, help find a contractor. We don't have a list of approved contractors because we're not in that business. The borrower has to pick one. So the RENO project manager does everything necessary for successful execution and delivery of the renovation loan experience. This is us, dedicated professional. We work directly with our salespeople. We're their back office to make sure that everybody has a good experience with this renovation loan.
Well, and that can be a difference too. So, someone said the problem with the loan is it takes an additional amount of time to close. Well, if you've been working with someone who doesn't have a dedicated team, a project manager who's going to manage that through the entire process, it can take a little bit longer. So, and that's part of that misconception that the industry has with these types of loans. And so having that dedication, having that project manager on there that's going to be seeing it from the beginning all the way through to completion, not just when, the home closes, but all the way through is important, because everything that happens and they're responsible for are all of these things, right?
Yeah, so they're going to review the file after it comes in. We underwrite the file first. So this is good for you guys. You will know shortly after your contract is executed if we have a deal. We underwrite the file first based on the borrower's financial position, their credit, income, assets. Okay, so then the RENO project manager reviews the file. They have a call with sales and the consumer. That's 2 different calls usually to make sure everybody understands which type of loan they're doing, what the requirements are, and then they get busy working with the borrower to collect all the RENO specific conditions. In our world, they redisclose the loan. That means because the numbers keep changing from the initial loan, and the RENO project manager is responsible to getting the credit package and RENO package submitted to the underwriter for clear to close as quickly as possible. And speaking of the underwriter, having underwriters who understand renovation loans also sets us apart from other people who just use their regular underwriters to underwrite renovation loans. So the underwriters know nothing about renovation generally, and it makes them incredibly nervous. They're hesitant to do it. They ask for lots of conditions that make no sense, and they really can slow down the project if they don't kill it outright, if they don't understand it because they're not comfortable signing off on it.
Perfect. The other thing that I love is end-to-end customer care. So not only from, working with a seasoned loan originator who knows the entire process, is certified in renovation loans, because that's a requirement with Finance of America certification for originators. And so they understand it, they know the ins and out, an assigned project manager who's going to handle that, and then all the way through that customer care that takes place all the way to when all of the renovations are completed. That makes a huge difference, William.
It's a huge difference, and the customers really like it.
Absolutely.
They don't get talking to. It's just they just feel more comfortable.
Yeah, and they get to know their project manager. They can call them with questions. They're really part of the team. And by doing that, it gives you the ability, and I love that you put this in here, is to sell the dream, right? And so it's important as a real estate agent, to remember what, William?
To remember that people have visions of what they want their home to look like, and this is how they get there, right? They get to choose the finishes, the appliances. They can change the windows. They could reconfigure the house. They can open up the floor plan, and so it takes the house that they found and really turns it into their ideal or perfect home that they've been dreaming of, with the things that they always wanted to have, the features they wanted to have in their house. That's what you're selling them, really. It's not just the house, but the opportunity to get their dream home, or as close to it as they can afford. Put that in there, because some people's dreams are like big castles.
Absolutely. Yes. So I just reposted the webinar handout, the link. Everything that we went through today is on there. We didn't go through all the guidelines. It's not important for you as a real estate agent to know all the guidelines. What's important to know is that there are options out there for you. So if you're showing your buyers homes, remember to tell them, hey, this home may not be perfect, but that's okay. There is an option for you to get it exactly the way you want it. Or if you have a listing for a home, or you're trying to pick up a listing for a home, my gosh, you guys, if you're out there picking up listings, which is what y'all want to do, this is a great opportunity to come into a not so perfect house and say, that's okay, because I work with certified professionals on renovation loans. And so make up a little flyer for them, get the little handouts, hold an open house, do those kind of things, and position yourself as the expert. And that's really our goal today, is to provide you with information to make you aware that this product is available. It's not the product that you're used to. It's not maybe what you've heard people in your office talk about, or other real estate agents talk about. And it's definitely different with Finance of America, because we bring to you not only the great programs, the expertise, but also the project manager and the guidance available. So I want to thank all of you for attending the webinar today. Thank you for the challenges we had with the Zoom. I've never seen it do what it's doing today. We are recording this. I will send out a recording to everyone, a copy of a recording that'll come out to you tomorrow. William, thank you so much, as usual, for your expertise.
Ginger.
And
Thank you
we
very
will
much.
see you all soon.
Okay, thank you. Bye, everybody.